and we just want to take some action. Because that's what we've been kind of taught to do in our societies, just take some action, take some action. But our action is much more effective if we plan first, and then we're taking with actions within our plan. That's why our planning cycle is a circle, because it is a cycle. And our growth cycle in the prosperity experience, which is how we deliver our financial planning process, starts with engage. Engage is about intent, goal setting. What do you want to create? How do you build that foundation to know where you're headed? In empower, there is the process of planning. Okay, so we know where we want to go. How do we put some plans together? And how do we evaluate our choices within those plans? So we can really, in empower, we're saying, well, if I do this, I get this result. If I do this, I get this result. If I do this, I get this result. So we're making really clear decisions. So we're making the decisions that really take care of us. And we're setting an action plan. We're then deciding what we're going to do. The third step is enrich. So, okay, now we've said we're going to do this. We have to actually go do it. So what are the things that I need to do? And then I need to monitor that against my timeline to make sure those things are happening. And the last one, envision, is, wow, I got through this cycle, and now I need to really reassess and see if I need to make any changes. Things have maybe shifted in the environment, in my life. What do I need to do? And the circle starts again. So it is a continuous process. It isn't a process that begins and ends. It just has a circle. It's all ongoing. These are some of the components of the prosperity experience. And it is basically developing a partnership with our clients. We don't see ourselves as we're advising, but we're really creating partnerships. How do we create a partnership so that we're helping you make the decisions that are effective for building wealth in your life? Lesson 3 is the patient payoff. So one of the things that we looked at when we looked at the cycle of the garden is there's some waiting and there's some anticipation. And this is what from a garden perspective, this is what the patient payoff might look like. If I plant one tomato seed, on average, I'm going to get 25 tomatoes, okay, on average. Sometimes more, sometimes less. If I take those 25 tomatoes and I save all the seeds, I'll have 5,000 seeds. That's a lot, isn't it? If I plant those 5,000 seeds, I'm going to get 5,000 tomato plants, which are going to produce 125,000 tomatoes. Now, this conceivably is in like 2 garden cycles. If I plant those 125,000 tomatoes, I'm going to get 25 million tomato seeds if I harvest all those seeds. So what is that? How does that relate to money? Have you ever seen the Rule of 72? Okay. Well, the Rule of 72 is how long does it take your money to double? And the 72 divided by your rate of return is how often your money will double. So now your money, it'll double in any way. Remember I said when we were looking at the tomato, on average, one tomato seed is 25 tomatoes. It could be 15 tomatoes. It could be 35 tomatoes. So there's some variability in the harvest. Same is true in our investment cycles. Here we could have a 6% or 8% or 10% return. The last year we would have been all happy for it to be anything positive, most of us. But let's say this is a long-term average return. If it's at 6%, using the Rule of 72, 72 divided by 6, it takes 12 years for our money to double. At 10%, it takes 7 years for our money to double. Now, in both cases, the money doubles. So if I have $10,000, what does that mean? It means at 10%, I have how much in 7 years? How much? 20. If I have $1 million, and in 7 years, I have what? 2 million. Now, both are the same effect. But it's a lot more fun to think about having $1 million and having it be 2 million than to have 10 and have it be 20, right? But how do you get to the million? You start with the 10. I mean, you start somewhere, and the compounding effect is always at work. So what we know is we have to reach critical mass. The same is true of our garden. We have to reach critical mass before the harvest gets really, really interesting. So our money is always working for us. And if we're more conservative, it might take a little longer than if we're more aggressive, but it's still going to work for us. If we look at a little more close-in example, this is the Standard & Poor's 500, the largest 500 companies in the U.S. And we say, well, it's, one of the things we know about investment returns is not exactly 1% or 2%. It's often positive and negative. We don't have 6% or 12%. We have variable returns. And this is an example of someone who took $100,000 in 1974 and they left it invested in the Standard & Poor's 500 until 2008. Now, the first year, who remembers 1974? Yeah, so some of us are old enough to remember 1974. It was kind of like the last year, wasn't it? It wasn't a particularly fun year. So if you were unfortunate enough for your great uncle to give you $100,000 and say, the only thing I request is that you take this $100,000 and invest in the Standard & Poor's 500, you would have had $73,500 at the end of your first year of investing. And what would you thought about your uncle? Getting a little old, not really all there. At the end of 75, you would have gained back a little bit of your money, but you would have had $86,000. Are you excited about the whole idea of investing yet? No. You are not excited. You are convinced that there's something wrong with your uncle, but he's made you swear that this is what you would do, and you're in school, you don't have, no better to use the money, so you stay invested, and at the end of 76, you have $106,000. You've now been invested 3 years, you have $6,000 to show for it. Are you excited? No, you're still not excited. And then what happens in 77? You lose some more money, you're down below $100,000. And this, of course, doesn't assume that you're paying any taxes on the money, or on the gains or losses. 78, you've got 105. 79, you have 124. So as you can see, we've got some ups and downs. Now in 2008, we had a big down, but at the end of 2008, you end up with $2.3 million. So if I didn't show you the in-between on these charts, and I just said, would you be happy if you took $100,000 in 1973 and you ended up with $2.3 million in 2008? What would you say? So I'd be pretty happy. What did you think of your uncle? He's a pretty smart guy. Pretty smart guy. But what we have to do is we have to recognize that not all harvests are equal. We have some positive and some negative harvests. And some of them are really not fun. Here in 1999, you go from $3.3 million to $2 million. And I'm not advocating that you have an investment, that your portfolio look like this. But I'm just giving you an example. This is an example of if you chose to do this. Okay? I'm going to actually tell you what I would advocate before we're finished. Don't worry, but I wouldn't advocate this. Just an example of something that we consider a fairly high-risk investment, something that a level of volatility that most of us are uncomfortable with, and yet, over a long period of time, pretty good result, right? An average of 8.8%, which most of us would be pretty happy with. Okay, so lesson 4 in the garden is risk is the only certainty. Now, isn't that a bummer? You know, the one thing I can count on is that there's going to be risk. And how does that kind of look? Well, in the garden patch, we have weather, we have constant change. Tomorrow isn't going to look like today. Spring can come early or late. Fall can come early or late. We can have a drought. We can have too much rain. We can have, this year wasn't very hot. We didn't have a good tomato harvest. All those things can happen. In our economic environment, we have constant change. We have changes in interest rates, taxes, and inflation. Who thinks taxes are going to go up? So I would bet on that. So we have constant change, and that constant change gives us a certainty. There's the certainty about the change. But there are also fundamentals. And we talked about soil earlier in the garden. The soil is a fundamental. And in our economic system, there's some fundamentals. If we're investing, there's some fundamentals in our investments called profits, cash flow, and as Warren Buffett would tell us, a sustainable competitive advantage. It's what we're looking for when we're looking for an investment. Can we pick a company that has a sustainable competitive advantage? These are the fundamentals. But despite the fundamentals, profits in a company can be going up, and the stock price can be going down. Now, why does that happen? Companies making money, companies making more money, but the stock price isn't going up.
The outlook's still bad.
The outlook's still bad? What's the what?
The company's market share has changed.
The company's market share might have changed. Profits. It could be that we're just in a bad economic cycle. What happens is, one of the things I know about markets is that when we talk about markets, which we're going to talk about it a little more in detail, public markets, who shows up to buy and sell in public markets every day? People, okay? And are people always rational decision makers? No. We think we are, and actually you can even read articles on the rational market. But if you let a psychologist tell you about decision making happens in the emotional part of our brain first. And we have to actually process there first before we get to the rational part of our brain. So sometimes the fundamentals look very positive, but the public markets aren't related to that because we really run a cycle of fear, optimism, and balance in our public markets. Fear, optimism, and balance. Fear, optimism, and balance. Always happening. Right now, we're getting a little more optimistic. What was happening earlier in the year, and especially last fall? Huge fear cycle. Huge fear cycle. Now, that doesn't mean that there aren't some fundamentals that sometimes drive prices down as well. Sometimes prices are falling.